Let's take a look at the stock market's performance for the year 2022 and see just how stocks purchased during that year performed if you would have dollar cost averaged in each and every month. Now, we'll be taking a look at specifically the S&P 500, and we'll be comparing that to my portfolio of individual dividend stocks to see which one performed better. All right, so the stock market in 2022 did not perform all that good. The S&P was down nearly 20% for the year, the worst return since 2008, where the stock market dropped almost 40%. Now, the best sector in the S&P was the energy sector, up nearly 60%. The worst sector was communication services, down nearly 40%. And surprisingly, there was 139 stocks that ended the year in the green by an average of 22%, of which none of those stocks I own, and 363 stocks ended the year in the red by an average of 24%, which I'm sure those are the stocks that most of us own. All right, so taking a look here at the indices, as we just saw, the S&P 500 was down nearly 20%, but that's not accounting for dividends received, and that's also assuming you purchased at the beginning of the year and held until the end of the year, with no purchases made in between, which doesn't really tell the whole story, which we'll get into a bit later. But just to highlight the other major indices, the Dow Jones Industrial Average did surprisingly well, quietly only losing 9% for the year, absolutely crushing the S&P 500. And remember, the Dow is only 30 stocks, which includes the likes of Apple, American Express, Chevron, which I'm sure helped a lot in the returns for the Dow this year. But that's the Dow Jones, and it did really well, surprisingly. Lastly, here we have everyone's favorite in the NASDAQ, which did the worst from the three at a negative 33%. It was a rough year for growth stocks, especially with all the rate hikes and inflation. It was just an overall tough year for the NASDAQ. But how does that compare to my portfolio? Well, at least according to Fidelity, I surprisingly enough outperformed the S&P 500 by just a tad. I was down 17.5% during the year, accounting for dividends, while the S&P 500 was down 18%, also including dividends. And again, this is just from the beginning of the year to the end of the year. So this return calculated by Fidelity is definitely better, since now we're including dividends as part of the return, unlike just looking at the index like we did before, where we saw the S&P 500 drop nearly 20%. In reality, it was closer to 18% than to 20%. But anyways, I am glad that I was able to outperform the S&P 500, even if it was just by a little bit. But over time, I do want to see the 3, the 5, and the 10-year beating the S&P 500. The only major index that schooled my portfolio was the Dow Jones Industrial Average, down being just under 7% for the year. There was no way I was going to beat that. But I'm definitely going to try to beat that next year. That's going to be one of the goals. I'm coming after the Dow next year and try to outperform it for 2023. All right, so before getting into the DCA data, I thought this monthly returns chart by Fidelity was actually pretty interesting. And we'll actually tie this back to the data in a little bit, and you'll get what I mean later. But very quickly, my portfolio was in the green and in the red the same months as the S&P 500. However, I was able to beat the S&P 500 7 out of the 12 months, which is pretty cool. The worst month for 2022 was definitely September for the S&P 500 and as well for my portfolio as well. And let's remember that the worst month in 2022 in terms of returns was September. Let's keep that in mind for later. Okay, so let's take a look at how the S&P 500 performed if you would have dollar cost averaged in all throughout 2022, and let's only count purchases made during the year. So as you can see here, I pulled the data from a Google Sheets that gives you the days high and low of each trading day in 2022. For this example, I used the ETF VOO. I picked VOO because that's the ETF I would choose if I were just going to invest in the S&P 500 and dollar cost average in. Then by taking the average price of each day for each month, we get an estimated purchase price in which we would buy VOO and dollar cost average in theory. As we can see here, the first month of January, as an example, I would have purchased VOO at a price of about $4.19, and I would have gotten 6.6 shares. Now, I am assuming that I am purchasing $2,746 each month, and yes, that is a weird number, but I'm only using that number because that's the monthly average that my individual stock portfolio came out to be. So my individual stocks, I purchased around 2,746 each month for 2022. So having that simulation, that comes out to just under $33,000 invested over the course of the year, resulting in 88 shares owned by the end of the year if I would have purchased each and every single month this amount. And that would have resulted in a value ending the year at around $31,000, and that's a negative 6.2% return. So negative 6.2% compared to negative 19% that the S&P 500 did during the year is a very big difference. And that just goes to show when you dollar cost average in throughout the year, you're not going to receive the full negative impact of the year in your portfolio. You're definitely going to have less risk. All right, now taking a look at how my purchases during 2022 performed, aka me trying to dollar cost average in throughout the year. So on the left, those are all my purchases made in 2022. I ended the year buying, of course, under $33,000, which the value of those purchases at the end of 2022 came out to $32,000 or $1,000 more than if I would have dollar cost average into the S&P 500. So my return for the stocks purchased during 2022 also would have beat the S&P 500 if I would have dollar cost averaged in, which is pretty nice. I lost 2.5% on the stocks purchased during the year, and if I would have bought VOO during the year and I would have done the same thing, I would have lost about 6%. Now, taking a look at my purchases on a monthly basis, we can see that my best stocks actually came in September. Now, if you remember from earlier, September was the quote-unquote worst month for the year. Well, that was actually the best month to buy stocks. So the stocks that I purchased in September ended up returning 8% by the end of the year, which was the best month to be buying stocks in 2022. So overall, I'm actually pretty happy with how I dollar cost averaged into this year. My goal was to invest a minimum of $2,000 each month, and I tried to invest more on the months where the stock market was going down. And as we all know, the stock market was going down pretty much every single month for the year, so I invested as much money as I could. The only bad thing really was that for some reason I skipped the month of August. I don't remember why exactly I didn't make any purchases during that month, but that's something definitely to improve for next year to make sure I purchase each and every single month. Now, if you're curious to which stocks I purchased, I basically purchased these stocks as you can see here on the screen. I didn't really sell anything. The only stock I sold was Store Capital because they were going to be purchased out. These were the stocks in my portfolio that I held throughout the year. I think there were a few new additions to the portfolio, but this is pretty much all the purchases I did in 2022. And the best performers of the stocks purchased in 2022 were Cummins and Raytheon, both returning 11% by the end of the year. And my worst picks were Disney and Nvidia. Those stocks that I purchased in 2022 ended up being negative 23% by the end of the year. All right, so overall, I think dollar cost averaging into the market is a great way to invest over the long term, especially with individual stocks. It definitely minimizes your risk if we go through a tough year in the markets like we did in 2022. However, I do want to mention that the stocks held prior to 2022 went down by the full percentage. Okay, dollar cost averaging in 2022 doesn't help you or doesn't magically escape you from the loss of 2022. The stocks that you held at the beginning of the year that you purchased in years prior, those were dropped by the full percentage. But dollar cost averaging does at least help reduce the losses for that year's purchases. And what I mean by that is if you would have just purchased everything in January and not purchased throughout the year, you would have had a 20% loss in all your purchases made in 2022 if you did them all in January. Now, if you would have spread out your purchases throughout the year, as you saw, buying the S&P 500, you would have only lost about 6%. And if you had individual stocks, at least in my case, I lost about 2.5%. And lastly, I also want to mention this would be the opposite. If the market only went up during that year, the gains will in theory be lower because the highest amount of gains would have been if you would have purchased the lump sum at the beginning of the year. But in my opinion, I feel like that risk is not worth it. I rather make a little bit of less money and lowering my downside. So yeah, I think dollar cost averaging is one of the better ways to invest in the stock market, whether it be through ETFs or through individual stocks. And as for my portfolio, I do want to strengthen my portfolio in 2023. I want to get rid of some holdings and add some better holdings to my portfolio. And of course, try to beat the S&P 500 as well as the Dow in 2023. But I guess time will tell. We'll see how things turn out. I have no idea if this year is going to be another red year or if we're going to flip the script and have a green year. I don't know. But what I do know is that I'm going to dollar cost average in, pick the highest quality dividend stocks, and let the portfolio do the rest. All right, hopefully the video was helpful, and thank you so much for watching.